The United States Treasury has launched a gigantic $514 billion borrowing binge, putting us in the fast lane of financial instability. The currency plummets, and foreign investors put the brakes on American assets. Tariffs are back in full force, trade tensions are rising, and the economy is teetering on the brink. We'll explain how each of these advancements is shaking up the automobile industry and why it matters for your checkbook, wrench, and weekend trips. Buckle up. Here are the primary factors behind this economic transition. A $514 billion cash drain. The Treasury accelerates debt repayment. In a daring move, the U.S. Treasury disclosed intentions to borrow $514 billion in Q2 2025, much above its previous $123 billion forecast. The 317% increase is due to a lower-than-expected cash starting point and narrower net inflows, all while seeking an $850 billion reserve by June, assuming Congress resolves the debt ceiling in time. This huge increase reflects the growing budgetary hardship. Since the debt ceiling was reintroduced in January, the Treasury has faced severe constraints, resulting in a liquidity crunch and urgent borrowing demands. The markets are split. Some investors regard the move as necessary to keep the government functioning properly. Others believe that it will boost interest rates, increase inflation risks, and make financing more expensive for both families and companies. Beyond the immediate cash flow concern, this borrowing frenzy reflects broader uncertainty, ranging from trade policy to market volatility. The path ahead isn't just about statistics. The question is whether Washington can avoid default and restore trust. Investors and consumers alike are increasingly paying close attention to the government's financial management. Speaking of worldwide reactions, let's take a look at what's occurring with the U.S. dollar. Foreign investment has stalled as the dollar falls. As of April 2nd, 2025, the U.S. dollar has plunged 9.2%, the greatest drop since the 2008 meltdown. This isn't simply a blip. This is a full-fledged confidence crisis. The dollar's decline, triggered by trade tensions and debt concerns, has sent a strong signal. Global investors are going in reverse. Over a 2-week period, foreign investors sold $36 billion in U.S. Treasury bonds, raising fears about America's appeal as a safe haven. The dollar's devaluation may benefit U.S. exports on paper, but it's a cost-raising nightmare for import-heavy industries like auto manufacturing. Import expenses for steel and semiconductors are rapidly increasing, driving inflation along with them. Where is the smart money going? Gold. There's much of it. In just 1 week, $15 billion poured into the precious metal as central banks, particularly in China and India, hedge their bets against dollar-denominated securities. That is not merely diversification. It's a deliberate shift away from what they see as an unsteady American engine. With the currency falling and capital outflows rising, the United States is in a perilous situation. The consequences for gearheads and garage companies alike might include increased parts costs, interest rates, and long-term finance. Stability is now running lean. However, economic pressure is not the sole factor that grinds gears. Let's discuss tariffs. Tariffs force the economy into reverse gear. The Trump administration's 145% tax on Chinese goods in April 2025 sparked a quick response. China responded with a 125% tax on U.S. imports. What was the result? A trade war that is disrupting global supply chains and driving up costs across sectors. The consequences are already apparent beneath the hood. The United States GDP fell by 0.3% in the first quarter, the first drop since 2022, due to panic imports ahead of tariffs and a reduction in government expenditure. Consumer confidence also fell to its lowest level since May 2020. Major players are feeling the squeeze. Apple revealed a stunning $900 million in tariff-related costs. Meanwhile, importers of essential components such as solar panels and industrial chemicals are seeing profit margins drop by up to 40%. Not only is Wall Street struggling, these ripple effects are spreading to the production floor, dealership lots, and eventually, your garage. Tariffs may be intended to defend U.S. companies, but growing prices and interrupted trade flows indicate that the solution may be causing more harm than good. Policymakers are now faced with a difficult decision between protectionism and economic suffering. So how does the government defend its harsh approach? Enter Scott Bessent. Bessent's blueprint faces real-world resistance. At the Milken Institute Global Conference, Treasury Secretary Scott Bessent made a bold plea. America, despite the instability, remains the focal center of global banking. What's his strategy? A three-pronged approach: trade reform, tax reduction, and deregulation. A tried-and-true technique for reigniting development. He envisioned a future of simplified licenses, reduced administrative burdens, and investor-friendly legislative changes. The aim was obvious: reassure a nervous market that the United States still has unrivaled capital depth and strong legal safeguards. But not everyone supported Bessent's engine refurbishment. Citadel's Ken Griffin did not mince words when he called the tariff regime crony capitalism, a system in which the government selects the winners and leaves the others in the dust. Other financial giants expressed similar worries, citing uncertainty as a key drag on long-term trust. In principle, Bessent's strategy boosts the economy. In actuality, it will require more than just polished speeches. Investors expect more than just a strategy. They want results beneath the hood. Until it happens, skepticism will remain in the background. This takes us to the path ahead. Tight twists and severe slopes await. As the economic trip continues, the United States confronts a formidable uphill struggle. The Treasury's $514 billion borrowing maneuver raises concerns about whether government debt is pushing out private investments. That matters to both gearheads and company owners, as higher interest rates may impede financing and hinder growth. Finally, there's the tariff trap. Trade disputes are more than simply political noise. They're affecting balance sheets. Tariff-hit nations are forging new economic partnerships to shift power away from U.S. markets. If America wants to remain in control, it must adapt to a rapidly changing globe. Meanwhile, investor confidence remains low. The shift to gold and foreign assets reveals more than just short-term concerns. It indicates that global parties are waiting for confirmation that the United States can maintain its course. We've seen how swiftly economic policy can affect the shop floor, increasing part costs, disrupting supply channels, and straining customer demand. Whether it's Wall Street or a small-town garage, the ripple effects are evident. So, where does this leave us? Let's conclude with our ultimate conclusion. The United States economy is at a critical juncture. With the Treasury's record-breaking $514 billion borrowing plan, a sinking dollar, and a wave of market uncertainty, it's apparent that the path ahead requires an aggressive but balanced economic strategy. Trade reforms, tax breaks, and deregulation may provide a path to recovery, but potholes persist. Promises alone do not build global confidence. It necessitates proof, genuine economic resilience, and smart navigation through turmoil. So, what are your thoughts? Will this aggressive borrowing plan accelerate growth or overheat the system? Are foreign investors correct to evacuate U.S. markets, or is this merely a momentary pause? Can America reclaim its economic advantage without jeopardizing global partnerships? Please share your views, takeaways, or wrench-side perspectives in the comments section. And if you haven't already, click the subscribe button to remain tuned for additional car updates, trade breakdowns, and real-world automotive insights. Thank you for watching, and see you next time.